This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Big vote postponed. The House will not vote on the health care overhaul today as tensions on Capitol Hill run high.
Blind spot. Ford surprises investors with a profit warning, just as the automaker tries to transform its business.
Boycott spreads why some of the world's biggest advertisers are pulling their money from Google's YouTube. Those stories and more tonight on Nightly Business Report for Thursday, March 23rd.
Good evening, everyone, and welcome. The vote on health care delayed. It will not happen tonight. Last-minute negotiations to convince more lawmakers to vote in favor of the Republican health care bill failed. The postponement left the first major legislative effort by the president and the House Speaker, Ryan, hanging in the balance. Tensions were high all day. Healthcare stocks fell. As a result, the broader market turned negative as investors tried to figure out what this delay might mean for the timing of tax reform legislation. John Harwood has been following the drama on Capitol Hill all day. So, John, what was really the biggest obstacle here?
Well, the core problem, Sue, is that you have a health bill which is going to inevitably be less generous than Obamacare in terms of subsidies for people to buy insurance. That's why Obamacare was so difficult to pass. You have two groups of people. One, the Freedom Caucus, that wants it to be much more stripped down than it is. They think the House bill is Obamacare light. You've got another group of people, 23 House Republicans in districts won by Hillary Clinton in November, who thinks it needs to be more generous, that it needs to be closer to what Obamacare was. It's very hard to square that circle, and they ultimately, with only being able to lose 21 members, they were not able to make a deal, and it's not clear they can make one tomorrow.
So what does happen next? They've been talking about maybe a vote tomorrow. Is that likely? What's next? It
is possible, but remember, in Congress, you typically don't put something on the floor unless you know you have the votes, and I had an exchange by text message with a House Freedom Caucus source this evening who said, when I asked, could the bill pass tomorrow if you negotiate all night? And the answer was, nope, no way. So the distance between the two factions and the speaker who's trying to bring them together is very, very difficult to do. Not clear that anything ambitious in terms of rolling back Obamacare as opposed to just fixing it is going to be able to pass this Congress.
And I'm sure part of the discussion tonight will be the Congressional Budget Office, which put out a new estimate on the health care bill's cost. What did it show?
Well, a couple of things. One, it showed it was more expensive, so there's less deficit reduction. Initially, they estimated $330 billion over 10 years. That was something that was a selling point for members who care about the debt. Now that deficit reduction is down to $150 billion because the House initially revised the bill to make it more generous. But it doesn't do anything, according to the CBO, in the number of people who would lose health insurance. CBO says by 2026, there will be 24 million fewer Americans with insurance than under Obamacare. That's very difficult, and polls out today show that this bill, as the public is perceiving it, is not popular right now.
All right, John, we will wait and see. I know you'll be on the case for us. John Harwood in Washington.
On Wall Street, the healthcare vote is viewed, of course, as a test of the Trump administration's broader agenda, which includes tax cuts. The major indexes were higher early in the day, but then turned lower once reports surfaced that the vote would not happen tonight. And by the closing bell, the Dow Jones Industrial Average was off 4 points to 20,656. The Nasdaq down by nearly 4, and the S&P 500 dipped 2.
Our next guest tonight says growing concerns about what will get done in Washington may cause problems for the market in the weeks ahead. Joining us is Chris Meekins. He is the research policy analyst at FBR Capital Markets. Chris, nice to have you here, as always.
Thanks, though.
So is it a case of if they can't get this health care bill done, they probably won't be able to get or at least get to it as quickly, the other aspects of the president's agenda?
There are three potential paths forward in our view. Either they pass the bill, the health care bill, in the House and the Senate, in which case tax reform becomes much more likely. If they pass it out of the House sometime on Friday or Monday, but they can't get it out of the Senate, then sentiment probably stays about neutral to where it is for tax reform. If they fail to get this out of the House and do nothing on health reform, then that does negatively impact the future options related to tax reform, and we think it makes it a much, much heavier lift.
How can you do tax reform, Chris, if you don't know what the price of health care is going to be to the federal government?
Well, largely speaking, at least with health care discussions they're having now, they want the changes they're making to health care to be budget neutral. So they would look at, from a tax perspective, trying to get tax reform itself to be budget neutral related to a whole different set of items. And they'll probably use dynamic scoring, which is assuming some type of economic growth, more positive economic growth than the current status quo, to look at ways to try to reduce the deficit and make those numbers add up.
So, Chris, handicap what you think all of this will mean, given the three different paths. For the market, I would assume we may see more volatility?
Yeah, no question. We think that over the next 6 weeks, you have a lot of specific items related to policy that could negatively influence the market one way or the other. So you have the health care bill in the next couple days. If they get health care done out of the House, this continues a discussion in the Senate about health care. You've got a Supreme Court nominee in 2 weeks that we anticipate a contentious confirmation vote. And then at the end of April, you have a government funding which expires. So you face the threat of a government shutdown if Republicans and Democrats aren't able to reach some sort of bipartisan compromise to continue government funding. All things considered, means there's a lot of volatility potentially over the next 6 weeks in the market.
A little more on tax reform. Does tax reform necessarily mean reform of both the corporate tax code and the individual tax code, or could you break the two apart and do the one that is most important to business, which would be reform of the corporate tax code, going to a territorial system, bringing back foreign-held profits and so forth?
There's no question they could only do corporate tax reform. I think politically speaking, it's difficult to see them doing so. When you're trying to do tax reform, you want to be able to give something to everyday Americans. The president's approval rating based on Gallup is below 40%. Congress's approval rating is not much high, is about half that right now. They're going to be looking to do something to show that everyday average Americans benefit from Republicans controlling the White House and Congress. So we believe, at least at this moment, corporate tax reform has to be tied to individual tax reform going forward.
Chris, thank you as always. Chris Meekins with FBR Capital Markets. President Trump's pick to lead the Securities and Exchange Commission said he has no specific plans to dismantle the rules that govern Wall Street. But at today's confirmation hearing, Jay Clayton said the law known as Dodd-Frank should be examined.
I do believe that Dodd-Frank should be looked at, in particular rules that have been in place as to whether they are achieving their objectives effectively. But I have no specific plans for attacking a particular provision of Dodd-Frank, Senator.
Democrats raised concerns that Mr. Clayton's work as an attorney on behalf of Wall Street firms would be a conflict of interest. Mr. Clayton said his past experience would be a strength.
Meantime, President Trump's choice to lead the Department of Agriculture was pressed about the administration's proposed cuts to the agency. At Sonny Perdue's confirmation hearing, the former Georgia governor told lawmakers that he had some concerns about the budget blueprint, but was committed to the well-being of the nation's farmers.
As a member of the administration, I view this budget similar to what, as governor, when I'd get a revenue estimate that I didn't like as well. I didn't like it, but we managed to it.
And Mr. Perdue added that it is possible to do more with less.
Ford is warning shareholders that profits in the first quarter will fall sharply and come in well below what Wall Street was expecting. And that sent shares of the automaker lower in trading today. Ford says rising costs are hurting its bottom line at a time when the company is trying to make some big changes to its business. Phil LeBeau has the details.
Ford is trying to steer through a bumpy period where business is strong but feeling pressured, while investments in future technologies like autonomous drive vehicles are pushing up costs. As a result, Ford's first quarter earnings will be at least 20% lower than what Wall Street was expecting. One factor is the growing investment CEO Mark Fields is making in the Silicon Valley, where Ford is doubling the size of its staff. The company has spent more than $1 billion on tech firms that will help Ford vehicles steer their way through traffic as autonomous drive vehicles become more common. But it may be years before we see that technology in the cars and trucks we're driving. In the meantime, it's what Ford sees in showrooms right now that worries Wall Street. Customers are still buying, but increasingly they can drive better deals. In part because there's a glut of used vehicles for sale. So as their prices drop, there's a concern that could eventually weigh on Ford's new vehicle profits. For now, Ford says industry sales this year in the United States should still reach close to a record high. One reason why the company is still maintaining its full-year earnings guidance. Phil LeBeau, Nightly Business Report, Chicago.
Still ahead, will truckers keep on trucking?
I'm Morgan Brennan in Ridgefield, New Jersey. With more than 2/3 of America's goods moved by truck, this is an industry with a direct take on the economy. Well, now truckers are sounding off on how President Trump can boost business. We've got that story coming up on Nightly Business Report.
Healthcare was also on the agenda at the White House today when the president met with a group of trucking executives. He praised their work and told them they played a vital role in the economy. But after a tough 2016, are things looking up for that sector, especially under an administration that wants to roll back some regulations? Morgan Brennan reports tonight from a truck stop in Ridgefield, New Jersey.
Big rigs rolled into the White House today as trucking executives met with President Trump to talk healthcare regulation and infrastructure. The trucking industry is the top employer in 29 states, including 3.5 million drivers who haul 10.5 billion tons of freight each year. It's a highly regulated industry. Many rules ensure drivers are at their best on the road, and companies are in favor of those safety standards. But there are other regulations the industry would like to see scaled back. Covenant Transportation Chief David Parker says one example is the EPA emissions rules.
Our engines have had EPA mandates since 2004. Since that time, my truck prices have doubled. And so the industry has been in a very tough position for the last few years from a profitability standpoint because our costs have been rising much faster than what our pricing has been able to rise.
He and others would also like to see the age requirement to move freight across state lines lowered from 21. They argue that would help ease the driver shortage the industry suffered for years. Don Daskey, CEO of Daskey Trucking, says infrastructure is also crucial.
We need the infrastructure bill, and we're willing to do our part. Let's increase the gas tax. We'll pay part of it. If you want to have tax changes, tax reform for part of it, that's fine too.
Daskey's fleet would benefit from better roads, but also the demand for transporting all those building supplies.
It's all speculation for now, but if new policies do deliver more growth, that will drive demand for more trucking.
I think there's going to be some exciting times in the trucking industry. I think the economy is going to go very strong for the next few years. I think that we'll see many quarters of 3 to 4% GDP growth.
With trucks hauling 70% of America's freight, that would be good news after the industry's rough financial ride last year. For Nightly Business Report, I'm Morgan Brennan in Ridgefield, New Jersey.
Well, strong demand for memory chips helps Micron's earnings beat expectations, and that is where we begin tonight's market focus. The semiconductor maker said demand, along with a price rise for its DRAM memory, helped results. Revenue up 58% year over year, and shares of Micron initially spiked after hours following the report, adding to a more than 1% gain during the regular session. They closed that session at $26.47. The packaged foods maker Conagra said fewer discounts helped its quarterly profit top estimates. But the maker of Chef Boyardee pasta and Reddi-wip, they don't really go well together, said overall profit and sales slipped due to foreign exchange rates and the company stopping the sale of some of its less profitable items. It's moving to more premium products. Conagra shares off a fraction at 40.35.
Penn National Gaming raised its first quarter guidance thanks to strong, broad-based property performance. Also, last night, the casino and racetrack operator said it will be added to the S&P Small Cap 600 index starting on Monday. Penn National Gaming rose nearly 12% today to $17.18. And shares of the apparel company PVH continued to rise following yesterday's after-the-bell earnings that beat estimates. The owner of Calvin Klein and Tommy Hilfiger brands, she tried to say, also increased its current share buyback program by another $750 million. PVH rose about 8.5% to $98.55.
Johnson & Johnson is the latest company to suspend its digital advertising on Google's YouTube. The concern is that the company's ads may have appeared next to offensive videos. As we reported yesterday, AT&T and Verizon also pulled their business. Google has committed to better police its website, but that didn't help shares of the parent company Alphabet, which fell by 1% or more today. Julia Borston has more on Google's YouTube ad problem.
Johnson & Johnson and AT&T, among the biggest advertisers in the world, are dealing a blow to Google's YouTube, pulling their digital ad spend globally. AT&T, which spent over $1 billion on ads last year, saying, quote, "We are deeply concerned that our ads may have appeared alongside YouTube content promoting terrorism and hate." They're joining Verizon and Enterprise here in the U.S. following a U.K. boycott of more than 250 companies. This wave of boycotts after the Times of London flagged anti-Semitic videos Google failed to quickly remove, and Volkswagen ads playing on a YouTube channel of a pro-terrorism extremist.
It's timing with a broader realization across the advertising community that not all digital advertising is the same.
These brands are concerned not just about optics, but about financially supporting offensive content creators. YouTube pays content creators with revenue from ads. Google saying, quote, "We've begun an extensive review of our advertising policies and have made a public commitment to put in place changes that give brands more control over where their ads appear. We're also raising the bar for our ads policies to further safeguard our advertisers' brands." But this problem could be much harder to fix at YouTube than at the rest of Google.
It's incredibly hard for these platforms to keep up with the content and be able to properly categorize it as is this appropriate. We want to juxtapose this advertiser next to it. I do think once new technologies come about where you can have facial recognition and content recognition technologies that can analyze images and actually see the type of content it is, maybe then they'll catch it, but it doesn't exist yet.
Bank of America Merrill Lynch cautions it could take several quarters for spend levels to return to normal, while Mizuho expects minimal near-term earnings impact to YouTube's projected $12 billion in gross revenue this year, but warns that Google must nip this issue in the bud to avoid broader repercussions to YouTube's brand. The degree of damage to Google hinges on how quickly it guarantees this will never happen again. For Nightly Business Report, I'm Julia Borston in Los Angeles.
So let's turn now to Rob Frankel to talk more about what Google's ad problems may mean for the brands of both Google and the digital advertisers who use YouTube. He's a branding strategist at robfrankel.com. Rob, welcome. Good to have you with us. How big a deal is this for Google and YouTube? I mean, if they're starting to see big companies like AT&T, Verizon, Johnson & Johnson, and others melt away, that's serious. Or is it?
Well, from a PR standpoint, I'm sure you're correct. But one of the worst secrets in all of online advertising is nobody really knows how well that works. So if they decide that, for the public, they want to try and remedy the situation, bully for them. How much a boycott's really going to hurt and how long these guys are going to stay out of the game, I don't think it's going to be all that much of a deal.
So let me follow up on that. Do you think then that they're using this content adjacency issue as a cover potentially for the idea that the ads just aren't working? And if the ads were working better, they'd stick.
Well, I think that's a very astute observation. Let's face it, the business of business is dollars over the transom. And if nobody is going to be that quick to pull something on a political agenda if they know that it's bringing in the dollars. Clearly, and this has always been a problem with online advertising, nobody knows what works. All they really sell are eyeballs. They don't really know where their ads appear. And this really shows you. Now, your ad agency is going to say, hey, it's going to work in this content. But they clearly cannot target content. And that's a bigger issue.
I think one of the issues, and correct me if I'm wrong, is that oftentimes a brand like a Johnson & Johnson or an AT&T or a Verizon doesn't know where the ad is going to be placed because it's basically done by a computer, and therefore their ad could be placed next to questionable content, and they may not know it until people complain.
Well, that is definitely true, but you also have to remember that most digital advertising, some of it is content associated, but believe it or not, most of the ad sales business is still based on 30, 40, 50-year-old eyeball technology, which basically means how many eyeballs are looking at it. They really don't care who's looking at it. They just want to be able, based on a cost per thousand or cost per million basis, to get that billing. And that's where the deals are.
So why did this happen this week, Rob? Did somebody wake up at AT&T or at Verizon and go, boink, some of our ads are showing up next to hateful content? I mean, it's not like this was new. What happened?
This story has such deeper roots than anybody would imagine. The same thing happened here that happened with Brexit, what happened with the populist movement, the rise of everything. What's really happening isn't so much in the ad sales, it's in the content creation. It's in these people who are memeing entire movements. And now, more than ever before, there are well-funded movements that are just throwing content out there like never before. They're getting the eyeballs, and the number of eyeballs is pulling in the ads.
Interesting point. Rob Frankel with robfrankel.com. Thanks very much.
Coming up, a man with a plan. Can Macy's new CEO turn around the iconic department store?
A changing of the guard at Macy's, the nation's largest department store chain, has a new chief executive. His name is Jeff Gennette, and he takes over at a difficult time for the retailer. Courtney Reagan tells us now who he is and what his plans are for the deep-rooted American company.
Today, on his 65th birthday, Terry Lundgren's 14-year tenure as Macy's CEO comes to a close as 55-year-old Jeff Gennette moves into the C-suite. Gennette has been with Macy's his entire career, starting in the executive training program in 1983. He was elevated to president and heir apparent 3 years ago. While most Macy's watchers say Gennette is ready and right for the job, he inherits the department store at a difficult time. Macy's shares have lost half their value in the last 2 years, as comparable sales have fallen for 8 straight quarters. And the retailer is also closing 100 stores as traffic falls at many of its locations and in malls.
I think Jeff, in general, needs to really think about several factors. The rise of off-price and how do they compete against stores such as TJ Maxx, Ross stores, and others. Also, we just really need more people to go to the mall. We need more physical traffic. That's a big issue, too. And then the consumer. The consumer has profoundly changed. They really need to get goods in the store quicker in terms of the supply chain, responding to fashion trends, as well as just getting your stuff really quickly.
Gennette gave Wall Street a glimpse into his plan for Macy's last week. He still thinks the department store is relevant today and calls stores pillars of the community, but says the challenge is making them contemporary. His plan is to do it by improving the fundamentals, brand, merchandise, and the mix between digital and store offerings. Part of Gannett's plan includes designating areas of each store for clearance and simplifying its sale promotions to eliminate what Gannett says makes shoppers do math gymnastics. Macy's is also testing more do-it-yourself shopping, like putting multiple shoe sizes on the floor so customers won't need an employee to fetch them, as well as hands-on beauty product testing, similar to what Ulta or Sephora offers. Gannett is also looking at adding more shop-in-shops. Many Macy's stores already feature their own Sunglass Hut, Finish Line, and more. LensCrafters is a recent addition, and it's been driving shoppers into stores. Many worry that even with all the right strategies, though, the largest U.S. department store by sales is fighting an uphill battle against a shrinking department store sector. But Gannett isn't discouraged. He's been working for the opportunity his entire career. For Nightly Business Report, I'm Courtney Reagan.
And finally tonight, Americans plan to spend more than ever on Easter this year. According to the National Retail Federation, spending will reach roughly $18.5 billion, which is up 6%. And what will all that money be spent on? Well, the survey found that most of the dollars will go towards clothing, gifts, candy, of course, and flowers, and a few toys in there as well.
Very nice. Happy Easter in a few weeks.
In a few weeks.
We've got time to plan.
Hope you all have a chocolate bunny in your basket. Okay, that's Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
Thanks for me as well. I'm Tyler Mathisen. Have a great evening, everybody, and we will see you back here tomorrow night.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world, its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.